Global Monetary Watch, August 1st, 2026. Today we bring you an in-depth examination of three very different currency stories developing across the global financial landscape. As international markets continue to respond to changing economic conditions, central bank decisions, trade adjustments, and domestic reforms are shaping the future direction of economies around the world. In this report, we will analyze the Iraqi Dinar, the Vietnamese Dong, and the Venezuelan Bolivar, three currencies operating under completely different economic circumstances. Rather than focusing on speculation, this analysis examines measurable economic factors, institutional developments, and policy decisions that influence how currencies function within the global financial system. Currency markets are influenced by a complex network of factors, and no single event determines the strength or weakness of a national currency. Interest rate decisions, inflation levels, foreign currency reserves, trade performance, government policies, and international confidence all contribute to exchange rate movements. For emerging economies especially, understanding these factors requires looking beyond short-term discussions and examining the deeper economic structures supporting each currency. The next 60 days will provide important data points for analysts watching these markets, as governments and financial institutions continue implementing policies designed to address their unique economic challenges. Before examining individual currencies, it is important to understand the role of the United States dollar in global finance. The dollar remains the primary reference currency for international trade, commodity pricing, and financial transactions. When the Federal Reserve changes monetary policy, the effects can extend far beyond the United States, influencing borrowing costs, investment flows, and currency stability around the world. A stronger dollar can create pressure on developing economies by increasing the cost of imported goods and foreign debt obligations. Meanwhile, periods of dollar weakness can provide additional flexibility for some emerging markets as they manage their own monetary strategies. While major currencies such as the euro, Japanese yen, and British pound receive significant attention, emerging market currencies often reveal important information about broader economic trends. These currencies reflect the challenges and opportunities faced by countries dealing with economic transformation, industrial development, resource dependence, or financial instability. However, analyzing these markets requires careful attention because short-term movements can sometimes create misleading impressions. Real economic progress is usually measured through long-term improvements in institutions, productivity, financial systems, and government policies rather than temporary market reactions. The first currency examined in today's report is the Iraqi Dinar, which remains connected to Iraq's broader economic transformation efforts. Iraq's economy has historically depended heavily on oil exports, with crude petroleum providing a significant portion of government revenue and foreign exchange earnings. This dependence has created both advantages and challenges. Energy resources provide an important source of national income, but reliance on one major commodity also exposes the economy to fluctuations in global oil prices. As a result, Iraqi authorities have continued focusing on reforms aimed at creating a more balanced and resilient economic structure. One of the most important areas of development in Iraq has been the modernization of the country's banking sector. For many years, challenges involving financial infrastructure, international banking connections, and informal cash-based transactions limited the ability of Iraqi financial institutions to fully integrate with global systems. In response, authorities have worked toward improving banking procedures, strengthening compliance standards, and expanding electronic financial services. These efforts are designed to increase transparency, improve transaction monitoring, and create stronger connections between Iraqi banks and international financial networks. Improving banking compliance is considered a significant part of Iraq's broader economic reform process. Modern financial systems depend on accurate record-keeping, secure payment channels, and effective oversight mechanisms. International banking relationships require institutions to meet established standards related to transparency and financial regulations. By improving these systems, Iraq aims to strengthen confidence in its financial infrastructure and create conditions that support broader economic activity. These developments represent gradual institutional changes rather than immediate changes to currency valuation. Alongside banking reforms, Iraq has also focused on reducing its dependence on oil revenue by encouraging growth in other sectors of the economy. Expanding non-oil income sources can include improvements in taxation systems, customs administration, private sector development, agriculture, and manufacturing. A more diversified economy can provide greater stability because government finances become less vulnerable to changes in global energy markets. However, economic diversification is a long-term process that requires continued investment, policy consistency, and effective implementation. For currency analysts, understanding the Iraqi dinar requires separating confirmed economic developments from unverified claims circulating online. Exchange rates are influenced by broad economic conditions, including inflation management, foreign reserves, trade flows, and confidence in financial institutions. Historical examples from around the world show that sustainable currency strength generally develops through gradual economic improvements rather than sudden changes, without supporting fundamentals. Therefore, examining official data and documented policy actions remains essential when evaluating Iraq's monetary environment. Institutional trust plays a central role in every currency system. A national currency depends not only on the physical notes issued by a central bank but also on confidence in the institutions responsible for managing the economy. For Iraq, strengthening trust involves maintaining consistent monetary policies, improving communication, expanding digital payment systems, and ensuring that financial regulations are effectively enforced. As more transactions move through formal banking channels, monetary authorities gain improved visibility into economic activity and can better manage financial conditions. Over the next 60 days, observers monitoring Iraq's currency environment will likely focus on several measurable indicators. These include foreign currency reserve levels, developments in international banking connections, progress in electronic payment adoption, inflation trends, and government efforts to expand non-oil revenues. These factors provide a more realistic picture of economic progress than unverified discussions surrounding immediate currency changes. Careful observation of official announcements and economic reports will remain important for understanding the direction of Iraq's financial reforms. Moving from the Middle East to Southeast Asia, the Vietnamese Dong represents a completely different economic model. Unlike Iraq, where oil plays a central role, Vietnam's economic growth has been strongly connected to manufacturing, exports, and global supply chain participation. Over the past several decades, Vietnam has developed into a major production center, attracting international companies through industrial expansion, infrastructure improvements, and trade integration. This economic foundation creates a different set of factors that influence the performance and management of the Vietnamese currency. Vietnam's export-focused economy generates foreign currency through the sale of manufactured goods and other products to international markets. Electronics, textiles, machinery, agricultural products, and industrial components all contribute to the country's trade activity. A diverse export structure allows Vietnam to maintain multiple sources of economic activity instead of depending on a single industry. This approach has helped the country become an important participant in global manufacturing networks and has shaped the way monetary authorities manage the dong. The relationship between exports and currency stability is a key factor in understanding Vietnam's economic system. Strong export performance can support foreign currency reserves and provide greater flexibility for monetary authorities. However, Vietnam must also balance the needs of exporters, consumers, and international investors. A currency that changes too quickly in either direction can create challenges for businesses and households. For this reason, Vietnam has traditionally followed a managed exchange rate approach designed to maintain stability while allowing gradual adjustments based on economic conditions. Vietnam's approach to currency management reflects a broader strategy focused on maintaining economic stability while supporting continued industrial growth. Instead of allowing large and sudden exchange rate movements, monetary authorities generally seek a controlled environment where businesses can plan for international trade with greater certainty. This type of approach is especially important for a country that relies heavily on manufacturing exports because companies making long-term investments require predictable financial conditions. Exchange rate stability helps manufacturers manage costs, negotiate international contracts, and maintain competitiveness in global markets. For international companies operating in Vietnam, currency predictability is an important factor when deciding where to invest. Manufacturing facilities often involve significant long-term commitments, including infrastructure development, workforce training, and supply chain arrangements. A highly unstable currency environment can create additional risks for businesses planning future operations. By maintaining a managed monetary framework, Vietnam attempts to balance export competitiveness with a need to control inflation and protect domestic purchasing power. This balance is a central part of the country's broader economic strategy. The Vietnamese Dong's performance is closely connected to measurable economic indicators rather than short-term market speculation. Analysts typically examine factors such as industrial production, export growth, foreign direct investment, inflation trends, and international trade conditions. These indicators provide insight into the underlying health of the economy. A currency supported by consistent economic activity and productive capacity operates differently from currencies facing severe institutional or financial challenges. Understanding these differences is essential when comparing emerging market currencies across different regions. Another important factor for Vietnam is the continued evolution of global supply chains. Changes in international trade policies, shipping conditions, technology demand, and manufacturing patterns can influence economic performance. As companies adjust their production strategies around the world, countries with strong infrastructure and established industrial networks may experience changing levels of investment. Vietnam's ability to maintain its role in global manufacturing will depend on factors including workforce development, infrastructure expansion, trade relationships, and economic adaptability. Looking toward the next 60 days, analysts following the Vietnamese Dong will likely examine several important developments. These include export performance, global demand for manufactured goods, foreign investment activity, inflation data, and decisions made by monetary authorities. International economic conditions, including interest rate trends in major economies, may also influence financial flows into emerging markets. These measurable factors provide a clearer understanding of Vietnam's currency environment than unsupported assumptions or market rumors. The third currency in today's analysis comes from South America, where the Venezuelan bolivar represents a very different economic situation. Unlike Vietnam's manufacturing-driven model or Iraq's resource-based economy, Venezuela's currency story has been shaped by years of economic instability, inflation challenges, declining purchasing power, and institutional difficulties. The country possesses significant natural resources, especially oil reserves, but resource wealth alone does not guarantee monetary stability. Effective institutions, productive capacity, fiscal management, and economic confidence are all necessary components of a functioning financial system. Venezuela's oil sector remains one of the most important elements of its economy. The country has historically relied heavily on petroleum exports as a major source of government revenue and foreign currency earnings. However, challenges involving infrastructure, investment, production capacity, and broader economic conditions have affected the sector's ability to operate at previous levels. While improvements in oil production can provide economic support, rebuilding a stable financial system requires addressing multiple issues beyond energy output alone. The experience of Venezuela demonstrates that natural resources must be supported by strong economic foundations to create lasting stability. Oil production can generate significant income, but governments must also manage spending, maintain productive industries, and develop institutions capable of supporting sustainable growth. Without these supporting structures, resource revenues may not translate into long-term currency strength. This principle applies to many resource-dependent economies around the world. One of the greatest challenges facing the Venezuelan bolivar has been the impact of prolonged inflation. When prices rise rapidly over extended periods, confidence in a national currency can weaken as individuals and businesses search for more stable ways to preserve purchasing power. Rebuilding confidence after severe inflation requires consistent economic policies, effective financial management, and long-term stability. These processes often take considerable time because trust in a currency depends heavily on public expectations and institutional credibility. Another challenge for Venezuela has been the widespread use of alternative forms of payment and foreign currency in daily transactions. During periods of economic instability, citizens and businesses may seek alternatives when they lose confidence in the domestic currency. This behavior can create additional challenges for monetary authorities attempting to restore normal financial conditions. Establishing confidence in a national currency requires more than policy announcements. It requires sustained evidence that economic conditions are improving. External pressures have also influenced Venezuela's economic situation. International trade restrictions, changes in global energy markets, and infrastructure difficulties have affected the country's economic options. In addition, unexpected events such as natural disasters or disruptions to essential systems can place additional pressure on government resources. For economies already dealing with financial challenges, recovery efforts can become more complicated as resources must be divided between immediate needs and long-term development goals. When analyzing currencies facing significant challenges, it is important to distinguish temporary improvements from lasting structural change. A short period of exchange rate stability does not necessarily indicate a complete economic recovery. Long-term improvement generally requires progress in areas such as inflation control, government finances, institutional strength, production capacity, and international economic relationships. Careful analysis must consider whether fundamental conditions are improving rather than focusing only on short-term market movements. Over the next 2 months, observers monitoring Venezuela will focus on several key areas. These include inflation data, energy sector performance, foreign currency availability, government economic policies, and developments involving international trade relationships. Each of these factors provides information about the country's ability to manage economic pressures. However, the overall situation remains complex because multiple challenges must be addressed simultaneously before meaningful stability can be achieved. Comparing Iraq, Vietnam, and Venezuela highlights an important lesson about global currency markets. Every currency operates within its own unique economic environment. Iraq's situation involves financial modernization and economic diversification efforts. Vietnam's currency is connected to manufacturing strength and international trade integration. Venezuela's currency challenges are linked to inflation, institutional issues, and economic recovery efforts. These different situations demonstrate why currencies cannot be evaluated using a single universal formula. Global economic conditions also connect these three countries in various ways. Changes in energy prices can affect both oil-producing nations and manufacturing economies through different channels. Shifts in global interest rates can influence investment flows and borrowing conditions. Changes in international trade policies can impact exporters and importers across multiple regions. Because of these connections, understanding currency movements requires examining both domestic developments and wider global trends. A major challenge in following currency markets is separating verified economic information from speculation and emotional expectations. In today's digital environment, financial discussions can spread quickly across online platforms, sometimes creating strong opinions before official data is available. However, responsible economic analysis depends on examining confirmed reports, government publications, central bank communications, and measurable economic indicators. Currency values are influenced by complex systems involving trade, inflation, productivity, reserves, and institutional credibility. Understanding these factors helps create a more accurate picture of how different economies are developing. For observers following the Iraqi Dinar, Vietnamese Dong, or Venezuelan Bolivar, the most reliable approach is to focus on evidence-based developments. Official economic statistics, central bank updates, international trade reports, and financial system reforms provide important information about a country's economic direction. These sources help analysts understand whether changes represent temporary conditions or part of a longer structural process. Economic transformation usually occurs gradually, with progress measured through multiple indicators rather than a single announcement or event. In Iraq's case, the coming period will continue to be closely connected to banking sector improvements and broader economic reform efforts. Strengthening financial institutions, improving international banking relationships, and expanding digital payment systems are examples of developments that can influence economic confidence over time. At the same time, reducing dependence on oil revenue remains an important challenge. Building additional sources of income through private sector growth and improved public financial management requires consistent policies and long-term implementation. The role of foreign currency reserves also remains an important factor for Iraq and many other emerging economies. Reserves provide central banks with tools to manage external pressures, support financial stability, and maintain confidence in the monetary system. However, reserves alone do not determine the strength of a currency. They work alongside other factors such as economic productivity, fiscal management, inflation control, and institutional effectiveness. A complete evaluation requires looking at the entire economic framework rather than focusing on one individual measurement. Vietnam's economic outlook continues to depend heavily on global trade conditions and manufacturing performance. As a major participant in international supply chains, Vietnam is influenced by demand from important markets around the world. Changes in consumer demand, technology trends, transportation costs, and trade regulations can all affect export activity. Maintaining competitiveness requires continuous investment in infrastructure, workforce skills, and industrial development. These factors contribute to the long-term performance of the economy and influence how markets view the country's financial stability. The Vietnamese central bank's monetary strategy demonstrates the importance of balance in currency management. Policymakers must consider multiple goals, including controlling inflation, supporting economic growth, maintaining trade competitiveness, and managing financial stability. These objectives can sometimes create difficult choices because actions that benefit one area may create challenges in another. A stable monetary environment requires careful decision-making and continuous adjustment as global conditions change. For Venezuela, economic recovery remains connected to rebuilding confidence in financial institutions and restoring productive capacity. Improvements in the energy sector may provide economic support, but broader reforms are necessary to create sustainable stability. Addressing inflation, strengthening public finances, improving infrastructure, and encouraging productive investment are all important parts of long-term economic recovery. These challenges demonstrate that currency stability depends on a wide range of economic foundations working together. Another important factor affecting all emerging market currencies is international investor confidence. Investors and businesses evaluate many aspects of an economy before making decisions, including political stability, regulatory systems, infrastructure quality, and future growth opportunities. Countries that demonstrate consistent reforms and transparent policies often create stronger conditions for economic participation. However, confidence develops over time and is usually built through repeated evidence of effective governance. The global financial environment also plays a significant role in shaping currency conditions. Interest rate decisions by major central banks, changes in commodity prices, and shifts in international capital movement can influence emerging economies. For example, higher borrowing costs in major economies may affect developing nations by increasing financial pressure. Likewise, changes in energy demand can create different effects for oil exporters, manufacturers, and commodity-dependent economies. The next 60 days will provide additional information about how these three economies are managing their respective challenges and opportunities. Analysts will continue monitoring official economic releases, policy decisions, trade developments, and financial sector updates. These observations will help provide a clearer understanding of whether ongoing reforms and economic strategies are producing measurable results. Careful monitoring remains essential because economic conditions can change as new information becomes available. A responsible approach to currency reporting requires avoiding exaggerated claims and focusing on realistic economic analysis. Every currency has strengths, weaknesses, opportunities, and risks based on the circumstances of its issuing nation. Presenting these factors accurately allows viewers to better understand the forces influencing international markets. Economic reporting is most valuable when it explains complex issues clearly while acknowledging uncertainty and the many variables involved. The comparison between Iraq, Vietnam, and Venezuela also highlights how different development models shape currency systems. Iraq's economic story is connected to resource management and financial modernization. Vietnam's experience reflects industrial expansion and global trade participation. Venezuela represents the difficulties faced by economies attempting to recover from prolonged financial stress. Each country follows a different path, and their currencies respond to different economic realities. Looking beyond individual currencies, the global economy remains interconnected through trade, energy markets, financial institutions, and international partnerships. A change in one region can create effects in another through supply chains, commodity prices, and investment decisions. This interconnected system means that currency analysis requires both local knowledge and awareness of global trends. Understanding the broader environment helps provide a more complete perspective on economic developments. For viewers following international currency news, the most important principle is maintaining focus on verified information. Economic data, official policy statements, and measurable reforms provide the foundation for understanding financial markets. While discussions about currencies often attract significant attention, meaningful analysis requires patience and careful evaluation. Long-term economic changes are typically built through institutional improvements, productive growth, and consistent policy implementation. As the global monetary environment continues evolving, the stories of Iraq, Vietnam, and Venezuela will remain examples of how different nations approach economic challenges. Their experiences show that currency systems are shaped by history, government decisions, economic structures, and international conditions. No two economies face identical circumstances, and each must address its own unique combination of opportunities and obstacles. As we continue observing these three different economic environments, the importance of accurate information becomes increasingly clear. Currency markets are influenced by many moving parts, and understanding them requires looking beyond headlines and focusing on measurable developments. Iraq, Vietnam, and Venezuela each demonstrate different aspects of global finance, from economic reform and industrial expansion to financial recovery challenges. By examining these situations carefully, analysts can better understand how national policies, international conditions, and economic structures interact to shape currency environments. For Iraq, the coming period will remain focused on the continued implementation of financial and economic reforms. Banking modernization, stronger compliance standards, improved payment systems, and efforts to expand non-oil economic activity represent important areas of observation. These reforms are part of a broader attempt to create a more balanced economic framework. However, economic transformation requires time, consistency, and effective execution. Monitoring actual progress through official reports and measurable outcomes provides the clearest way to evaluate the direction of these efforts. The Iraqi economy also continues to face the challenge of managing its relationship with global energy markets. Oil remains a major source of national revenue, making global energy conditions an important factor in government finances and foreign currency flows. At the same time, efforts to encourage private sector development and alternative industries could help create a more diverse economic foundation. A stronger economic structure depends on multiple sectors contributing to growth rather than relying heavily on a single source of income. Vietnam's economic path presents a different example of how production capacity and international trade can influence currency stability. The country's integration into global manufacturing networks has created significant economic opportunities, but it also means Vietnam remains connected to changes in worldwide demand. Maintaining growth requires continued investment in technology, infrastructure, workforce development, and trade relationships. The performance of these areas will continue shaping how international markets view Vietnam's economic position. The Vietnamese Dong's future environment will also depend on external factors, including global inflation trends, interest rate decisions, and international trade conditions. Because Vietnam participates deeply in global commerce, changes in major economies can influence export activity and investment flows. Policymakers must continue balancing economic expansion with financial stability. This requires careful management of monetary conditions and attention to both domestic and international developments. Venezuela's situation demonstrates a different economic challenge, where rebuilding stability requires addressing multiple interconnected issues. Restoring confidence in a currency after a period of severe inflation and economic disruption is a complex process. It involves more than changes in exchange rates or short-term improvements. Sustainable recovery depends on strengthening institutions, improving economic productivity, maintaining fiscal discipline, and creating conditions where businesses and citizens regain confidence in the financial system. The Venezuelan energy sector remains a key part of the country's economic discussion, but oil production alone cannot solve all monetary challenges. Resource wealth can provide opportunities, but long-term stability requires effective management, investment, and broader economic development. Countries with natural resources still need strong institutions and productive industries to create lasting financial resilience. This principle has been demonstrated repeatedly throughout global economic history. One of the most important lessons from analyzing emerging market currencies is that economic progress should be measured through realistic indicators. Inflation trends, employment conditions, trade performance, financial regulations, government finances, and productivity levels all provide valuable information. Looking at these factors together creates a more complete understanding than focusing on isolated events or individual claims. Responsible analysis requires examining the entire economic picture. The next 60 days will provide additional opportunities to evaluate ongoing developments in all three economies. For Iraq, attention will remain on financial reforms, banking improvements, and economic diversification efforts. For Vietnam, analysts will continue watching manufacturing performance, exports, investment activity, and monetary policy decisions. For Venezuela, inflation management, energy sector conditions, and economic stabilization efforts will remain key areas of focus. Global economic risks will also continue influencing currency markets. Changes in commodity prices, international interest rates, geopolitical developments, and trade policies can create new challenges for emerging economies. Countries with strong institutions and flexible economic systems are often better positioned to respond to unexpected events. However, every economy faces unique circumstances that require specific strategies and careful management. A balanced understanding of currencies requires avoiding assumptions that all markets follow the same pattern. Some economies may experience gradual improvement through reforms, while others may face extended periods of adjustment. Currency performance reflects the combined impact of economic policies, market confidence, productivity, and international conditions. There is no single formula that determines the future of every currency. For viewers following financial developments, the most valuable approach is to remain focused on credible information sources and verified economic data. Official central bank statements, government reports, trade statistics, and international economic assessments provide important context. These sources help separate confirmed developments from speculation and allow for a clearer understanding of real economic conditions. The stories of the Iraqi Dinar, Vietnamese Dong, and Venezuelan Bolivar demonstrate the diversity of the global monetary system. One currency is connected to a resource-rich economy undergoing institutional reform. Another represents an export-driven manufacturing economy integrated into global trade. The third reflects the difficult process of rebuilding stability after years of economic pressure. Each case provides important lessons about how currencies function within different economic environments. Understanding currencies requires patience because major economic changes usually develop over extended periods. Banking reforms, industrial growth, fiscal improvements, and institutional strengthening are gradual processes. Short-term market discussions may attract attention, but long-term economic fundamentals remain the foundation of sustainable financial development. Careful observation and evidence-based analysis provide the strongest framework for understanding these complex systems. As this report concludes, the central message remains that global currency analysis requires discipline, research, and attention to facts. The Iraqi Dinar, Vietnamese Dong, and Venezuelan Bolivar each tell a different economic story shaped by their nation's policies, resources, challenges, and opportunities. Examining these differences allows observers to better understand the forces influencing international finance. Global Monetary Watch will continue monitoring major developments across the world's financial markets, focusing on verified information, economic trends, and important policy updates. As global conditions evolve, understanding the fundamentals behind currencies remains essential for anyone following international economic news. Thank you for joining today's analysis, and continue following Global Monetary Watch for future updates on worldwide monetary developments.